Hey, thanks everyone for joining, and thanks Victor for having me. My name's Aran. I'm the co-founder CEO here at Archera. I'm also a former Amazonian, and I worked at Azure before that, so spent a whole bunch of time in my career in the cloud world, and founded Archera about 6 years ago to really bring a new type of primitive to the FinOps world, one that I viewed as really missing from the ecosystem of tools that I was building and shipping on the product side at Azure and at AWS, and one that I tried to pitch within the clouds and really because the finance teams have a very strict way of doing things, never got traction, which is this new way to de-risk commitments with really like a net new form of insurance, cloud commitment insurance, and how that helps customers avoid some of the key mistakes that I saw when I was, in my decade plus of work in the cloud, working with hundreds, probably thousands of really large end customers. So what I'm going to go through today is just a few common mistakes that I saw a lot of customers making around cloud commitments when I was at Azure doing things like launching, committed SQL Server instances there. And then even at AWS where I was launching SageMaker and seeing customers really start in 2016, 17, 18, go in for large GPU commitments, which are only more relevant now. There was really a common framework of mistakes that we would see customers make. I'm excited to go through those in some depth. But Archera is an Azure, AWS, and GCP partner. We offer this on all clouds. We're part of the Cloud Operations Competency Program within AWS and the architected program as well within AWS. So we're a consummate partner and often offer these services really in hand in hand with cloud reps on the AWS side and with many partners around the world. So diving into the material here. The number one mistake that I see customers constantly make, and I've seen this for over a decade in the cloud, is customers come in saying, "Hey, the cloud is great for R&D. I want to move fast. I want to spin things up, see if they work, shut them down," and that's great. But often customers spend far too long running in that experimental on-demand mode, even when their infrastructure and their usage starts stabilizing. So the number one mistake that we see customers make is waiting to commit until they have absolute confidence. And I'm an engineer. I know a lot of engineers get into the FinOps practice, and the thing that you want as an engineer is nines reliability. You want really high confidence. But unfortunately, when it comes to the world of cloud and building products and serving customers with cloud services, there is so much uncertainty that unless you are willing to accept that and make a commitment under that uncertainty, you're going to, one, be leaving money on the table, and two, you might never get to committing if you're looking for those nines of reliability that you're looking for in an engineered system in that long-term certainty of a service being up and running. So understanding a little bit about how customers think about saving money on the cloud, we really break it into two high-level buckets. The bucket on the left here in the graphic is what we call rate optimization. Now, this generally doesn't require engineers to have hands-on keyboard. This is done at the contract level. So if you've ever negotiated something like a private pricing agreement or a MAC at the really high end, or done something as simple as purchase a reserved instance or a savings plan, or more recently provisioned throughput units on some of the token-based services in the AI world. Those are all forms of a commitment, financial engineering or rate engineering that can help you lower the rates without having to go in and re-architect, rebuild your underlying systems. That's what's happening on the left-hand side here. On the right-hand side, we have more infrastructure impacting ways of actually optimizing your infrastructure and your cloud spend. And that includes things like right sizing, replatforming, terminating resources which are unused. And those are things where often you're going to need an engineer or a product team even that owns that infrastructure in the loop. And where Archera really focuses is on the left-hand side here. While we provide some visibility and integrate with a lot of tools and partners who work on the right-hand side here, our whole goal is to help customers really optimize with the native commitments, navigating all those different combinations, understanding the uncertainty of their actual usage, and then actually giving them a new tool in the tool belt in the form of commitment insurance, where if they don't use some of these commitments, we'll actually pay them back the difference to help customers really maximize what they can get out of the left-hand side here in terms of optimization. Now, if you look at what that insurance really looks like, this is sort of a simplified graphic to explain it, but in the AWS world, you really have three ways to buy. You can buy on demand. That's often where most customers start, running hour by hour, second by second, trying to figure out what is the right SKU here. How do these things work when you're building or migrating a new workload? And as you get more certainty, you can move into a fixed term 1 year commitment. So you're committing for 12 months. There's no getting out of that. That is like a fixed hourly bill that you're committing to for a certain instance or amount of spend. And then obviously, if you have really high certainty, you can go all the way out to a 3 year commitment. Um, the problem is these commitments are fixed term. You're paying for them the whole time. There's not a lot of flexibility. And you are always essentially, even if there is, flexibility insofar as you can move instances, you're always committed to a fixed amount of spend that is often growing. That's what the clouds want. They want you to commit more and more dollars. What Archera does is it actually allows you to essentially break some of these commitments, break some of these leases, and get some flexibility. So we'll write you an insurance contract that says, hey, for let's say a 3 year commitment that you have, we'll write you an insurance contract that says after the first year, for the next 24 months, if this thing goes unused, if you end up migrating, if you end up using less through an optimization that you did on the hardware and infrastructure side, we'll actually credit you back, rebate you back all of the cash that is sitting there in an unused commitment. So you can reclaim that money in that budget year and actually redeploy it to something that's more useful than a piece of infrastructure that you migrated off of but committed to. And that really creates a net new primitive, something that instead of being fixed term is actually flexible term, and something that really helps customers have certainty that they're not going to be left if they commit with this, even if it's a 1% chance, with this fixed cost sitting there in their cloud bill that they can't get rid of. So it's really a new tool in the tool belt, and we view it as filling the gaps in the native commitments offered by AWS or Azure or Google, who all have very, very similar commitment offerings. And the most interesting thing about this is because we've been doing this for 6 years, we have a ton of data, and we have a free platform that you can install to actually get, a sense of what you can do with native commitments, what that insurance on top of it will help you do in addition. And all of that's free of charge. You can do your cost visibility, planning, automation of all different commitment types. Through that, we actually find opportunities where you might have uncertainty, you might have risk, but that's risk that we're happy to underwrite. And when you look at the net savings, net of the premium that you would have to pay for the insurance, often they can look not just attractive, but even better than the equivalent options from AWS. So looking here um, at the equivalent EC2 AWS commitments, you have 1 year savings plans, 1 year reserved instances. These are the average savings rates that you can get. If you look at our insured 30-day option, for example, you only have to commit for 30 days. The next 11 months, if the thing goes unused, you're getting a check back straight to your bank account for whatever that unused amount is. And the net savings of that, when it is used at 100%, net of all the premium that we would take out, is 30%. So better than a 1 year savings plan. Equivalently, when you look at something like the 1 year reserved instance on the AWS side, you're seeing that it's about a 35% savings rate. If you commit for a 1 year guaranteed reserved instance, where that first year is fixed, just like it is with the AWS instance, but those next 24 months, you have insurance on. So if you decide not to use that commitment and throw it away, we'll be crediting you back basically every month that unused amount in cash to your bank account. You're actually net saving 45%. So often customers find that by introducing this insurance, even when they have a fairly sophisticated commitment strategy already, because they're willing to take some of that risk that the business often isn't willing to take, or the engineering team isn't willing to take, we can help them get more aggressive and get much higher savings rates than they would otherwise through their kind of native commitment strategy. Additionally, the beautiful thing about the premiums that we charge, they're all billed through the cloud marketplaces. They count towards private pricing, MAC, EDP burn down. So it really does fit in well with the broader FinOps and cloud commitment strategies that are often in place with larger and more sophisticated customers. So the key thing is when you have a tool like this commitment insurance in the toolbox where you can commit for a term as short as 30 days, 1 month, which means that from a break-even perspective, you really only have to use that instance for the next 18 days before you're in the green and you've saved money net versus wasted money. It just doesn't make sense to wait to commit. You can optimize at any time based on, really not a long track record of historicals. You don't need to be using something for 6 months to commit for it. You can use it for as little as 1 month or even 3 weeks before we're willing to underwrite insurance on it. And that really helps you avoid some of that downside risk, that opportunity cost of not committing. Because the most pernicious thing is that people don't see the money they're wasting when they're not committing. But that is a counter that's constantly ticking up as you run on demand and aren't actually making the commitments to infrastructure that's likely going to be around for a good amount of time. And even if you don't think it is, when someone's offering you insurance and a guarantee that you'll either save money after, the first 18 days of this running, right? Or at worst, it'll be budget neutral. It's something that's really worth considering. The second major mistake that we see is that customers get dogmatic about saying, well, I'm only going to use this one type of commitment. I'm only going to use savings plans. I'm never going to look at RIs. I'm only going to use RIs. I'm never going to look at provisioned throughput units. And what we see is customers, because they narrow the field of view, really lock themselves into often a suboptimal strategy. And we don't just see that with customers. We see a lot of, vendors and consultants in the ecosystem do this as well, where they say, this is the only way to go. There's no reason to not do it otherwise. And they ignore a lot of the complexity and depth and breadth of options that the cloud providers give to you, particularly AWS, which has, the most mature and built out platform when it comes to different flavors of commitments. So, talking about AWS commitments, you can see here that it goes far beyond savings plans. And even within savings plans, there is a variability. And within reserved instances, of course, there's a high degree of variability as well. So you have instance savings plans, which are very equivalent to standard reserved instances, with just the difference of operating system coverage. You have compute savings plans, which have pretty much the same savings rate as convertible reserved instances, but they don't have to be actively managed, and they essentially cover more services net. They cover things like serverless, et cetera. And then you have SageMaker savings plans, which cover those AI services from SageMaker. And then for a number of the database instances and offerings, as well as EC2, you have these reserved instances or reserved nodes, which are, very long-standing commitment types that have been around for over a decade. And I think many customers are used to using. All of these actually have their place in a holistic commitment strategy. And obviously, we believe they have their place alongside insurance, which we can write on top of any of these commitment types. It doesn't matter what the commitment is, be it one of these or a, private pricing agreement, we'll write an insurance quote against that. So, what do we think is probably the optimal way to look at this field of different options that customers have? Well, looking at strategically combining those different options where it makes sense given your infrastructure is sort of the strategy that we recommend to customers going forward. And actually, if you use our free platform, we'll do all this planning and put together different strategies for you that you can evaluate free of cost. 5-minute read-only install. So definitely recommend, if you're saying, oh, I'm only going to click the button on compute savings plans, maybe looking at where, even without insurance, other commitment options in that basket could actually help you get to a more optimal outcome given your historical usage. And so when you look at this, you want to figure out, all right, what are the different things that under the exact AWS rules, which are constantly changing, these different commitments can cover? And what are the savings rates that I'm going to get out of that? Now, if you're partnering with a vendor to look at this, just make sure that vendor is giving you all the options. If they're only showing you options with convertible reserved instances or only showing you options with compute savings plans, it's incumbent on you to ask the right questions and say, well, can I see some other options? What about instance savings plans? What about standard RIs? It's really on you to ask those questions to make sure that you are seeing the breadth of options that the cloud provider really offers to you and not, having your scope unnecessarily limited. And one of the things that we did in starting this company is really made it a priority to give a lot of that information out for free to customers. It's a free tool. You can play with it yourself. You can basically go to any line item and look at every single commitment option that can cover it. So all that complexity, if you want to dig deep, is there for you. But by default, we do recommend blended plans where we are looking at historicals and we are looking at all the different kinds of savings plans and reserved instances. And obviously, if you opt to include it, insured versions of those as well, that could make up a holistic strategy for a given piece of your infrastructure. And we do a lot of that, including the automation for free if you want to kick the tires and see, where your strategy is today versus what an option B could look like. But otherwise, there's always spreadsheets and AWS simple pricing calculator. So, that's another way that I'm sure if you have the time and willpower, you can go that way as well. And then the third major mistake that we see is that a lot of customers focus on their biggest line item. They'll only focus on something like compute. But as I showed before, there's a wide range and a growing range, actually, especially if you look at, Azure, where there's way more reservable services than AWS, where you can get a commitment to cover something that, maybe you weren't even thinking about. For example, we see a lot of customers using SageMaker and not understanding that, hey, there are SageMaker savings plans that you could use to even commit to a little bit of that. That is steady state, month over month or week over week. When we look at things like databases, especially, we see a lot of customers not covering or not committing to things like, DynamoDB or Redshift or RDS. Or Elastic Cache. And so really looking at all the different ways you can commit and save, I think is one of the key things that customers often miss when they're looking to just look at their big line item, commit there, and then walk away. And so, again, you have this mix of reserved instances and savings plans. We can write insurance on top of any of them. And we often see that there's a lot more uncertainty around usage of databases, usage of SageMaker. And so those are places where, things like our 30-day commitments often help you bridge that gap between, oh, I'm not sure if I can commit for 1 year, but I know this is a committable service and I've been running it pretty consistently and I don't want to waste money. So that's a very key place that I think we see customers often miss when they're going through and planning their commitment strategies, particularly smaller and mid-sized customers. So again, don't just focus for your big production services, EC2 and RDS when you're looking at commitments. Consider the whole long tail of services because often when you add a lot of those up, those savings could be material. In fact, in many cases, we see them being as big, if not bigger, than commitments to your production database on RDS. And so that's something again that a tool like Archera or other vendors that you're looking at, you should definitely ask them, all right, how many services are you covering? Do you cover every reservable service in this list? Or if you're working in the Azure ecosystem, do you cover this list? What's the other, 30, 40, 50 services that are reservable within Azure? You really are looking for completeness there. So you can be sure that any given service where there is the option to rate optimize, you're able to go and, one, plan it out, do some scenarios, figure out what the right options are for you, but two, and more importantly, include it into a broader commitment plan with, compute and database and AI, everything sort of rolled together. And not having to go service by service or having services missing and having to do those in the AWS console. Again, that leads to suboptimal outcomes versus having centralized plans with all services that could be used under a given team's umbrella or a given company's umbrella all in one place. And then the last thing that I think is important, especially with the rise of things like Bedrock and AI and a lot more R&D spend that has, often much more uncertainty than we saw with R&D spend of the past, where someone was standing up a new API endpoint versus committing to a big token-based service like Bedrock, is really understanding the right combination of native commitments versus insured commitments in the case of Archera, where you want to understand what steady state, what should I commit to with the cloud provider, and what has a little bit more risk around it, what has a little bit more volatility, and I should be seeking out something like an insured contract there so I can get the savings, but also hedge the downside risk if, DeepSeek comes out and surpasses Claude and I have to migrate, for example. So that's again a very key consideration that we see customers missing and that we recommend as part of our standard kind of free onboarding and analysis process customers really consider. And then the last kind of set of commitment mistakes here really start with this automation idea. Once you have the strategy, once you've considered all the options and the range of different ways that you can commit to the given services you're using, as well as, potentially even insurance on top of it with a vendor like Archera. Actually automating that process, especially for things like fast growing production segments of your infrastructure, and doing that maybe too early is another problem that we see customers often fall into, which again is kind of a one-way door. And so a lot of customers that have gone upside down on their commitments, they're paying for a bunch of committed usage that they didn't end up using, and obviously they didn't talk to our chair before, so they didn't have insurance on it. We often see customers coming to us saying, "All right, I don't want to do this again. How can you help me?" And so often it stems from an early automation of a strategy that may not have been the right strategy long term for the customer. So we really think about four key questions that customers have to ask before they click a button and say, automate this whole process for me. You need to understand, what are the cost and usage, and what's the granularity at which you can break it out by, what we call segments. What is the granularity at which you can break it out into COGS and R&D for different teams? And then how can you model those forward such that hey, for the next 3 months, this is going to be a pretty consistent, growth lever. We're going to onboard a new customer over the next 3 months in this segment. So every machine that comes over, we know the customer's on a 1-year contract and we should be committing to it, for example. So really understanding those granular forecasts for different pieces of your infrastructure is the first thing. Or don't have to be super granular all the way out to 3 years, but you should understand at least a quarter out. And then you have to understand what is the cadence of the renewals that the commitments you're committing to sort of imply. So if you're committing all up front at the beginning of the year and then have one big renewal at the end of the year, it actually leads you with less flexibility, insured or not, than actually committing a little bit throughout the year, what we call laddering, where you have things constantly renewing, which means you constantly have the ability to either not renew that commit, or renew up when that commit comes through, giving you a lot more flexibility than having just one gigantic renewal for all of your commitments at one point in the year. And then really looking at the next layer, you have to understand how customized can I actually make the automation? Obviously, if you build an automation script yourself, you can customize it to your heart's content, but the reliability might be a little shaky. Many vendors say, hey, it's a black box. We're going to do this for you. It's our way over the highway. Really, what you're looking for is often something in the middle. You don't want a black box because they don't know your infrastructure as good as you. So having someone else automate it without a lot of this granular information is, especially in this black box way, is often a recipe for disaster. And we see customers come to us with, completely upside down on their commitments because they handed it over to a third party. They messed up in a number of ways, and AWS didn't really go and correct the issue for them, leaving them in a pretty bad place. We've seen actually more and more of that over the last few years. So really understanding what are the granular customizations that you can put on the automation policy. Can you use all the different commitment types as part of the automation policy? Those are things that you're really looking for when you're considering what is the actual tactical way we are automating. And then the last piece is understanding, the risk management. So what happens if things go bad? What happens if this customer churns the contract that I've been purchasing, commitments against? So those are really things that require you to often bridge the gap with your finance stakeholders and understand, look, what does it look like when this fixed cost is sitting on the books? Because I'm automating this now and we're going to be purchasing, every hour or every day to meet the new workloads that are coming in. Now, obviously, something like Archera with its insurance helps answer that question. But even if you don't have that, you should be quantifying what is that downside risk and understanding, with automation, is that a risk that that's worth accepting for you? And then really it rounds out to automate only when you're comfortable, right? You should be purchasing plans by hand, manually, seeing how they perform for different pieces of your infrastructure while you're kind of getting a handle on modeling and forecasting. And you really need to be getting confidence in whatever tools you're using before you take the leap of faith to flip a switch and say, all right, cool, I'm going to put this on automate only mode. Even if you're running at scale and you're having to go in like every other day to go and do the manual purchasing, it's worth doing that just to gain that comfort level, which is really important before you should go and click the automate button and really walk through that one-way door, so to speak. And the last commitment mistake here that we see is often customers are thinking that it's a smart thing to do to hedge risk by instead of going from on-demand to 3-year for usage, particularly usage that could be covered by something like a savings plan, which is very flexible. They're often buying 1-year commitments and using that as a way to hedge the risk or split the difference. What we see is that 1-year commitments actually often aren't that worth it. And it's the reason why we have such attractive savings rates that we can give to customers by ensuring 3-year commitments with a 1-year term, such that those last 24 months on that 3-year term are flexible, where we can actually give cash back to the customer if it's unused. So our 1-year insured commitments often are, and actually always have a much higher savings rate than their native alternative within AWS. You don't have to renew those for another term. They just continue saving you money if you use them past that 1-year term. And on top of that, when you're really thinking about it, it's the equivalent commitment that's sitting there because even if you stop using it on day 366, we're paying for those next 24 months. So it's really not sitting on your balance sheet necessarily. And so when we think about advising customers through this, we often say, look, maybe that first commitment purchase, go for the 1 year. You're going to feel more comfortable with it. But as you gain that confidence, and I know 3 years is much longer than 1 year, it is worth considering going longer term, even if you don't have insurance, but especially with insurance, it just makes it a no-brainer to push out the term length and really increase the savings rate that you can get out of essentially providing that additional certainty with some of that downside protection in theory that we can provide. And then the last thing that we see here is delaying your enterprise commitment, so PPAs and EDPs. And this is another place where, just like with reserved instances and savings plans, we can help with insurance, but really also help with the planning and execution with a lot of our free tooling. So a PPA or an EDP within AWS is where generally you're spending kind of a million plus a year. And in exchange for a top level commitment to a total amount of spend over 2 to 5 years with AWS, you are going to get a blanket discount across all services. Now, this requires a much higher degree of long-term forecasting than committing to an individual reserved instance or savings plan. But often getting on one of these private pricing agreements is incredibly attractive from a savings perspective because unlike a reserved instance, or savings plan that only applies to one type of service, the blanket discount from a private pricing agreement applies to all services. And often there are services that don't have native commitments that anyone can buy in the console that you can get special pricing on by going through a private pricing agreement and committing in a private way to those services. So often, once customers get to that scale of $1 million+ a year of annual spend on AWS, the biggest opportunity cost that they are incurring and money they're leaving on the table in the commitments domain is by not signing or not exploring those PPA options and working with their Amazon rep to get something across the table there where they can lock in a fairly attractive discount across the entire AWS bill and very specific services if they are power users of certain services like CloudWatch, for example. So where Archera can help there is again with our free service. Not only do we help with commitment planning for our reserved instances and savings plans and automation of those and cost visibility on top of that to really help through that forecasting, planning, and execution process. But using those tools and a specific tool that we've built for private pricing agreement forecasting and planning, we can help you for free do your demand plan and figure out what is the number that makes sense to put in front of my AWS rep to commit to? What are the different scenarios here that would make sense without having to go and spend, 2 to 4 days in spreadsheets figuring it all out yourself? You can plug in 5-minute read-only install and generate these forecasts and scenarios right out of the gate. On top of that, what we help customers do is often AWS will not accept these private pricing agreements if you're not increasing how many dollars you're spending in year two and year three. And often, again, just like with 3-year commitments, customers are uncomfortable with that. So that is a place where our Archera can come in and offer to quote some insurance such that, let's say you are committed to spend $1 million in year one and they want you to spend 1.25 million in year two to secure that discount. Well, maybe that 250K you're not so certain about. That's a place where we can come in, write a contract, say, go commit to that. The premium's going to be less than what you save by committing to this private pricing agreement. And if anything goes wrong, we'll cover essentially that marginal $250,000 of unused commit if you overcommit on your private pricing agreement. And on the back end, what we can do there is if customers are over, even if you're not a customer of Archera on the insurance side today and you're over your skis on your PPA, we can go in and actually help with some shortfall prevention. So if you are, let's say at $1 million PPA and you're in October and you've only spent, say, 700,000 and you're not going to make the difference, we can help in those 3 months make up as much of the difference as possible to minimize that true up, even if you're not a insurance customer of ours. That's a completely free service that we offer. So again, it doesn't matter what the commitment type is, from reserved instance, savings plan, provisioned throughput units, all the way through to max and private pricing agreements. Archera has both free tools and this opt-in insurance that can really help you get the most out of these programs. So again, as soon as you're able to, especially given the free tooling that firms like Archera could offer, as well as some of these insurance options, as soon as you're able to take advantage of it, we recommend starting to think about, build the forecast for, and start the conversations around a private pricing agreement with your cloud provider. Again, a really low effort way on the engineering side to get a high degree of savings across a really broad swath of services. So the call to action here is very simple, as I've been saying throughout the call. If you are looking at revamping your commitment strategy, reevaluating your commitment strategy, if you're in a PPA and you're over your skis, if you're thinking about a private pricing agreement, or just if you're starting your journey on AWS, migrating and spinning up new infrastructure and trying to get that first commitment to move off of all on demand, these are all places where Archera can help. And we have a free platform. You never have to talk to a human. I'm an engineer. I would never want to talk to a human, but you can if you want to. You can schedule a demo there, but we have a free platform on the AWS Marketplace. It's read only. Click a button. It looks like a native app that you install. And you can start with free cost optimization, free commitment management of all native commitments, and start to get some of those insurance quotes to see how you can maybe get more aggressive with things like reserved instances, savings plans, and private pricing. If you want to talk to a human about this, you can, of course, schedule a demo there. But I would highly recommend if you are in one of those states as a customer, checking this out. Otherwise, we have a lot of great material that we release online on our website. So another great place where you can really read up more on some of the depth of optionality that AWS or Azure or Google gives you around things like private pricing agreements, reserved instances, and savings plans, and all the nuances around how those are applied, how the rules are set, and how they've been changing, and where Archera can help, or where you, as an individual user, can go and make smarter decisions on a go-forward basis around these AWS commitments.